All right, everybody. Welcome back to the Marty Grisani Show. I am super excited about this episode because I actually got I was gifted the chance and I took it, thank God, to be on this person's show. This gentleman, his name is Beau Eckstein, and he is a pro. Okay, this guy is a 20-year loan broker. He's been a part of hundreds of millions of dollars worth of transactions in real estate. He has a book coming out. He has a startup fintech company. He is one of the first people who have talked about a C-PACE strategy, and I'm probably not even explaining it right, but I know it's for turnkey providers for ground up lending. I just thought it was amazing, and I'm super excited to talk to him. He's a flip it to win it kind of guy. Beau Eckstein, everybody. Beau, welcome to the show.
All right. Thanks for having me. This is going to be fun.
Hell yeah, it's going to be fun. We had a great time on your show. I really appreciate that. And I know my listeners are going to benefit a ton from talking to, listening to you, me talking to you. So why don't you just tell people really quick kind of who you are and what you do and give us a little bit of the, Beau 101.
Sure. So in a nutshell, I finance real estate investors and business owners through SBA financing, through portfolio rental loans, short-term rental loans, multifamily bridge loans, pretty much anything real estate investor related or business owner related. That's what I finance. I got my start 20 something years ago as a residential mortgage broker. Thought I was really smart, bought a lot of properties in 2005 to 2007. Then I learned that markets don't always go up in value like we're seeing right now. There's actually cycles, and that was a devastating time when the mortgage industry collapsed. So there I was, a 20-something-year-old kid, and my business stopped because we couldn't make loans because nobody was making loans anymore, and businesses and banks were going under. And I had a lot of properties that I was speculating on the West Coast, and unfortunately those markets got clobbered. So I had an early midlife crisis in my mid 20s, and then I had to pick myself up off the floor and go, wow, that was like getting your butt kicked by like a UFC fighter, right? It was that bad. And that kind of humbled me and put me in kind of a state of depression for a while. And I said, well, what am I going to do? I don't have a college education. All I know is real estate. So what you have to do is you got to put your pants back on and you got to get back up. And anytime you lose at something, you got to figure out, okay, what could I do? What can I learn from? And then I just got back in, and then the mortgage business was like non-existent. And I'm like, I don't like it anymore because there's all these rules now that don't really they don't make sense really. They're not really helping the consumer. And then I was a real estate broker in California. I got my broker's license in 2007. I think I was originally a salesperson in 2001 around. So I started selling properties. I ran into a friend of mine, and I didn't realize that he was a managing member of a private mortgage fund, and they did fix and flip and construction loans for investors. So I started doing all the business development. We ended up starting our own brokerage, lending money to fix and flippers. I got into house flipping then because I'm like, hey, if these guys could do it, I could do it. And then it was so easy back then. You could just go on the MLS, pick off deals and fix and flip them and make money. I didn't have any credit. I had bad credit and no money at the time. So what did I do? I effectively partnered. I had a contractor that would do the work at cost, and a money partner. And we'd split profits a third, a third, a third. Did that for a long time. And then I started getting interested in commercial financing, and I started working with all these national debt funds as they emerged, because before we didn't have these big national funds that did these fix and flip loans. It was all like small funds and mom and pop type of private lending. So I started getting involved in that. I figured out how to do SBA financing. I figured out how to do construction loans. I figured out how to pretty much structure deals. And then that's where I'm at today. In 2013, I actually did a house flipping TV show. They found me on YouTube. That's why I'm a big advocate of building a brand. Whatever you are, if you're a house flipper, if you're a multifamily syndicator, you need to build brand and you need to build awareness. And I got really good at that. And that's where I'm at today.
I love it.
Yeah.
I love it. And that's, guys, you got 20 years right there. So I got to dig in here because that's a lot to eat. And I really actually want to start with something that I haven't been a part of. And a lot of my listeners and a lot of the people that are in my age group, this millennial and the whatever the generation before that who are investing, everybody looks so good right now, Bo. Right?
Yep.
Everybody looks good. But I know my forefathers had gone through some shit, and I think we, as investors, if you started in 2011, and if you just you're still in that kind of time, or 2010, whatever it is, as you start, it's hard to make a bad choice, really, because of the appreciation and what's going on in the market. So let's start with, so you said you had a bunch of rentals, right? Or you bought a bunch of properties. What was the deal? What were you doing? Where was this?
So I grew up in California in the San Francisco Bay Area, and then I relocated to Nevada. I lived in Incline Village, which is a very expensive market on the Nevada California border. We have Lake Tahoe, which is one of the most beautiful lakes in the world.
Yeah.
And so in this little area, they say the billionaires kick out the millionaires because it's all billionaires that live in this market. So
Okay.
we opened a mortgage company on that side because we needed a brick and mortar location to open a Nevada branch. And I ran a residential mortgage company. And then I'm like, okay, well, the market's booming. Let's start buying up as many properties as we can.
Right.
So I started buying properties throughout Nevada, which is one of the hardest hit markets when the downturn happened. I mean, property values decreased by 60%. So I was kind of
60%.
in some of that. Yeah, it
And
was
that can
crazy.
happen again, Bo.
Yeah, I mean, that was one of the probably biggest downturns in the history of the world. But yeah, I mean, it also
So you
created a
think
lot.
that might be just a 1,000 year flood? Like, hey, probably nothing to worry about for the next 10, 15 years.
Well, I wouldn't say that, but I would say that that was, I don't think we're going to see a 50% market correction in residential prices because there is kind of a shortage of housing, but I do think these corrections sneak up on us, and
Okay.
everybody's an expert, so everybody has their opinion right now.
Right.
But I think knowing what I know now, I wouldn't be speculating on big renovation projects. I would be buying properties that are more turnkey for rentals, that cash flow from day one, and that do have a value add component. So like if you're buying a fourplex and two of the units are already rented and that covers your debt payment, you're probably in pretty good shape to then renovate the other two units and so forth. But going into like a large spec deal where you're buying something, like people in San Francisco, for example, are flipping houses where they're buying them for 2 million, they're putting $1 million in, and then they're expecting to sell it for X million, right?
Right.
So those type of deals are potentially where you can maybe get caught because prices, the buying market could suddenly slow down, and then you're not getting, you can miss fire on large luxury deals pretty easily.
Right.
So I like to stay in the entry level kind of flip market. I'm not really flipping anymore just because it's a job, and
It is.
I have a lot of smart friends, and most of them get into doing bigger deals and doing syndications, and because you can leverage other people's money. So I think that is probably a better avenue to grow wealth quicker.
But you
Uh,
definitely do you believe that you became better at what you're doing because of flipping?
yeah, I mean, I think when I was selling houses, I think my competitive advantage is like, okay, we know how to like take this floor plan and open it up, make it more appealing. And so like when I was selling houses as an agent, because I own a small real estate brokerage too, that makes you like first of all, if you're dealing with a real estate agent and they don't own any real estate, they're usually not the best agent because
Agreed.
they don't know like what problems you should fix before you list the property and how to stage it, how to position it. Because there's certain things that you're going to get caught on, and then when the market changes, like right now, people are waiving contingencies. Oh, I don't need contingencies. But when the market changes, then the buyers are more picky, and then they can eat you alive. Like they can find things on the inspection and say, oh, well,
Right.
and then all of a sudden, oh, there's foundation issues and this and that. And then they get these inspectors that say it's going to be 50 grand to fix. And so then you start, especially in older housing stock, you find a lot of that kind of stuff. So right now, everybody's like, oh, no appraisal contingency, no inspection contingency. And I think that's when the market changes, that's where those people start getting picked apart. And then it's always sucks when you're on the selling side and you have that property, and and the inspector comes by and just eats you alive, and like there's not like 20 other buyers, behind that buyer, so you get kind of scared because you're paying 4 or 5 grand a month in debt
Right,
service, and
right.
oh god, that. And if you have a couple of those properties that you're feeding every month, it doesn't take long before you deplete your savings, and that's when you get into issues.
Yeah, and those are issues that happen with the flipping business because and we are in it, right? So that's something that we do. That's part of our one of our divisions is flipping. And you're so right when you said it's like a job. It really is. And you can't really scale yourself out of it, it feels like. I just don't see it, especially where we are. You really need to be in it full time. So it's just not something I don't think where someone can just hire a CEO to take over your flipping business. And I don't know, maybe that's a limiting belief, but it's what I really truly believe. And that's why we have pivoted into multifamily, like what you're talking about. And that's, one of the things on your, hey, here's something I want to know, Bo, on your show with Vinny Chopra, you talked about him getting an $8.7 million loan in 15 days. Can you do that for me? Can you promise that you can do that for me?
Yeah, I mean, money right now, money's easy to get. It really, on a multifamily deal, we have debt funds that it's pretty simple. It's kind of like the fix and flip formula. What's the purchase price? What's your capex or renovation costs? And what's your stabilized value? What's the ARV? We call it multifamily, call it stabilized value. So we get an MAI appraiser, and this is for 4 units plus. And so we can do 87% of total project cost, means 87% of purchase, 80% of rehab, on bridge debt. So then they fund control the construction. So it's just like a fix and flip loan, really. And our gross loan amount can't exceed 75% of the stabilized or the ARV. So it's very similar to like a fix and flip model, because most fix and flip lenders lend 70. The max loan gross loan amount can be 75% of the ARV. So they
That's
always say,
crazy.
yeah. So it's aggressive because hard money lending back in the day, we didn't have 30-year portfolio rental loans that you don't need income docs. Right now, it's like a blessing. I'm closing a few deals right now, and the rates have gone up so much in these DSCR loans now. Like
Can you
they
explain
were.
that a little bit, Bo? Because some of us, especially myself, we're getting into it, but we don't really know all the lingo lango. So what is that?
Sure. So what I do, or part of what I do, is a lot of investors, they burr properties, right? We
Correct, right.
buy, renovate, rinse, repeat, refi, not in that order. But anyways, um, so we get a fix and flip loan at 85, 90% purchase price, and then the lender holds back the construction. So we only need to put down 10%, right? 10 or 15% of the purchase price. And then we fix the property, but we're not going to sell it, because selling property is, short term. You get taxed the most on it. We really want to burr out of it. And we want to keep it as a long-term rental or short-term rental. And so then these DSCR loans, which are called debt service coverage ratio, we don't need to go to a conventional bank and give them our tax returns anymore. Debt service coverage ratio is based on your credit score, that the property cash flows, and the loan to value. That's how we price these loans.
That's it.
Yep.
Wow.
So on a cash out refi, you can go to about 75%. So if you burr correctly, you should be able to get all your money out at 75%, right?
And you might even be able to make money.
Yeah. If you buy really good, some people get cash back, and usually you want about
Right.
6 months of seasoning. So you want to wait about 6 months, because that opens the door to being able to use new appraised value.
Okay. No, so it really can be used, the same Burr model that you might use for a single family can truly be used for a 100-unit building.
Yeah. It's the same process.
That's insane. I think if people start to, and that's again easier said than done, but if you work on that and that your mindset is, hey, this guy or this person is doing it, why not me? Well, why not me? And that's what we continually stress in our company is why not us? And that kind of goes to for you, right? Well, that's your 20-year career is really impressive considering that you got punched in the face so hard when I'm sure that you have peers that also got punched and have completely either got out of the business or maybe they're still stuck down there. and spiraling. And maybe not. I hope not. But I know a lot of people have, because that's what happens. Here's another thing I want to talk about because I thought it was really interesting. Is this you are certified, or you're the only person I've ever heard that can? What's this PACE equity or PACE capital?
Sure. So CPACE financing,
Yes.
it's it's basically a state-enabled program. So not every state has it yet, but basically people that are doing like bigger construction projects where they're going to keep the property most of the time, it goes in the capital stack. So they might, so let's just say somebody's buying a distressed multifamily property and it's like 200 units. And they have a bank or a private mortgage fund that's going to lend 75% of the total project cost. It means they still got to bring 25% of equity in. So what CPACE financing does, it funds all the green eligible items in a construction build. And it's not a second mortgage, it's actually an assessment through the property taxes. So but basically they're encouraging people to build more green products like LED, it could be foundation. It just depends on the state. So it basically, for the developer, in a nutshell, gives them more equity in the deal.
Wow.
So they have to bring in less investor capital, essentially, right? So they get higher returns. Because if you the more LPs or limited partners you bring into a deal, you got to divvy up the cash flow into equity. So this is like an awesome tool. It's non-recourse debt that can fund up to 20-25% of eligible items in a construction build. So it's a lot of people in the hospitality, like hotels, people building hotels or doing adaptive reuse projects use CPACE in the states that are approved. There's about 20 something states that are enabled right now for that.
Is New York one of those? Do you know?
Yeah, New York. So every state has a little bit different caveats of what you can, and like California and Florida are like the two most liberal in the PACE, but
Oh, good.
Ohio and other states, yeah, but New York, you can. So it's a great tool. Like anything, like if you're a real estate investor, I think you need to have multiple tools in your tool belt. You need to have subject to. You need to know how to lease options. You need to be able to buy properties with none of your own money using other people's money, right? Like you can get a hard money loan and then you bring in what we call gap funding for the down payment, because you have to be resourceful, especially if you have no capital. You need financial capital.
So all these things you're saying are ways for people that don't have money to get, a deal done. I think the key thing is, and correct me if I'm wrong, Bo, but if someone has a deal, there's typically a way to get it financed. Is that fair to say?
Yeah, I mean, just think about it. You get a deal that you're getting an awesome buy on. You have a couple exits. You can wholesale the deal. You can bring in a joint venture partner. You can get a hard money loan for 80 to 90% of the purchase price and 100% of the repair costs. And then even the down payment you need, that 10 or 15% plus carrying costs and stuff, you can bring in a gap funding partner, right? That just funds the down payment. So, I mean, I structured a ton of deals with zero out of pocket for
Wow.
myself. That's the way to do it. Because if you don't have capital in your bank, how are you going to do it? You're going to have to leverage other people's money. If you look at these big syndicators that are buying these $50 million buildings, they're doing the same thing. They're not putting their money in the deal. They're raising money through a syndication, right? And so that's how people get really wealthy, is leveraging other people's money. And that's the
You're so
key.
right. You're so right. And again, this is a mindset shift because it on paper, the single family house, you can kind of wrap your head around that. But when you go into the 10, 20, 30, $100 million deals, it's a team sport. And you got to be someone who can put together the team and put together the deal, and you get paid handsomely if you're able to do that. So here's my question, right? So as an aspiring syndicator, what is something that you would suggest doing? Is it, hey, keep building your brand, Marty? Keep telling people what you do. Is it because I know you need to have a Beau on your team, right? You need to have someone that knows, the financing side better than anybody, right? I think let me ask you this. Do you think it's just somebody who can put together the best of the best?
Yeah, I mean, really, it comes down to like I've interviewed a ton of syndicators, and I'm not a syndicator right now, but But really, it comes down to this. I've interviewed everybody has the same story. I started with this single family, and then I got some duplexes. Then I realized that I can't scale this business. It's a pain in the rear. So then they learn about syndication. Oh, I can just raise money and I could buy bigger deals. And so when you actually do a syndication, you get a syndication attorney. But the beauty of this is that they have all these, as a syndicator, you have all these profit centers. You have a profit center, like when you do an acquisition, you get paid a fee. You get like a 2-3% fee on the total project, right? So I've been with a syndicator for lunch and he just made $1 million at the start of the project, 500,000 or 800,000 or 300,000 at the start from setting it up. That's his, kind of his finder's fee or his deal structuring fee. Then
When
there's
it
the asset
closes, right? When it closes.
when they, yeah,
So yeah, okay.
so when they buy the property, they get paid a portion of the cash flow, and then they get paid equity when they sell.
What's the normal split? Because is it like a
60,
70-30?
70-30 or 60-40, but usually 70-30.
70-30 is a normal split. So the
Eh,
GP or the general partner,
mhm.
that's the syndicator, right?
Yeah.
Okay. But there might be maybe 2 or 3 GPs, right? Or no?
Right. So these syndications, so let's just say I went out and found a deal and I'm buying a 200-unit apartment complex. And to get agency debt, well, everybody talks in multifamily about agency debt. That's Fannie Mae and Freddie Mac. It's non-recourse debt. It's the best multifamily financing besides HUD. But anyways,
And
so
non-recourse just basically means, so because guys, I'm learning as we do this, right? This is my own journey that also my listeners are following along, that I'm sure are typically on the same track as me. But is non-recourse basically means if something were to happen and things go left, sideways, I don't become liable where I then have to declare bankruptcy. Is that something about around the right what I'm thinking?
yes, you're absolutely correct. They do have what they call standard bad boy carve outs, meaning if you commit fraud, they can go after you and things like that. But so to qualify for agency debt, you need to have experience in that asset class, meaning if I don't own any other apartment buildings, I don't qualify there.
Well, real quick on that side. If I'm an LP on a multifamily, if I put money, does that qualify me as someone with experience?
No,
Damn it, Beau. Okay, keep going.
no, but it is good to be an LP in some deals so you can learn the process. So
Sure. Okay,
plus you
fair enough.
so then you need the GP needs to have a net worth equal to or greater than the loan amount. So
Okay.
shoot, I can't do that. The sponsorship team or the general partners need to have 10% post-close liquidity. So after you close, you need 10% post liquidity, right? So if you don't fit that, now I'm screwed. I can't buy this apartment because I don't have the net worth, I don't have the liquidity, I don't have the experience. So we're going back to team sport. So what do? I bring in my syndication partner that's got the experience, right? He gets a piece of the deal because he's a general partner in the deal now. Now we need somebody to sign that's got the net worth, and that's called a KP, key principal, right? And that person is the person with the balance sheet that can support the loan. Now that's how we form this sponsorship team and we satisfy all these conditions. So after I've interviewed all these people and friends with all these big syndicators, it's really a team sport, going back to it. So how do you get started from like, okay, I've done, X amount of flips and own, 50 rental properties, all single family. The quickest way to get a black belt in syndication is to co-GP. So you become a co-general partner, because that's going to put the rank on your black belt. You're going to get a red stripe now.
I love that. I love this analogy. It's amazing.
So what you do then is you one of your buddies is a big multifamily syndicator, and you say, hey, your next deal, I want to be part of it. And then there's certain rules within the PPM, which is called the private placement memorandum. Whenever you're raising money, you have to do it legally through a securities offering. So there's different securities offerings where you can only go after accredited investors. Accredited investor, there's rules like $1 million plus net worth, not counting your primary residence, things like that. And then there's some offerings that you can open up to everybody. So you got to figure out what kind of offering, and then there's certain ways that you can openly advertise and some you can only do to people that you personally know, because they'll come after you and they'll put you in
Mm.
jail.
Yeah, they will.
So what I do now, so this is my plan now that I want to get into syndication.
This is, by the way, this is awesome. This is
I'm get,
awesome. So like, this is like what people are looking for, and then they pay 30 grand to be coached. Truthfully, now I'm a big fan of coaching, but I'm just saying, this is what I was looking for 2 to 3 years ago when I was just starting. So, Bo, keep going, brother. This
yeah,
is awesome.
yeah. And I do think coaching has its place. I think where the coaching is really good is that you get it plugged into a network of other people like Marty and Beau's, and then you form your team there. So that's where it's worth it, because then somebody brings a deal. Hey, I need somebody to come on and help raise capital. Then they form the teams. So it does make sense. Like, I think
10,000%. 10,000%. Yes.
like, I'm not very analytical and I don't want to be in the spreadsheets on multifamily. So a lot of us are like, I don't want to do multifamily. I don't want to look at Excel spreadsheets. That's why you bring an underwriter on your team. Or you could outsource that to a third party. So the quickest way to accelerate your growth is then just, go to events, meet somebody who's got the experience, but might need some help in raising capital or some boots on the ground. And then you fast track the process, because now, even though I'm a minor partner, I'm a GP. Hey, I'm a GP. I can wear my baseball cap. I'm a GP. So that's how you get your experience, right? And then you just keep doing that over and over again. Now, like nowadays you hear people, oh, I got 3,000 units, but maybe they only own like 0.5% of that 3,000 units. So like I always say, really, that might not be the way you want to go. Maybe you just want to own 100 units yourself and you cash flow 50, 60 grand a month, and that's good enough for you. Or, there's some people that go on to own 6,000 units and they're worth 20, 30 million bucks, so net worth. So it just depends. But the other thing is, whenever you raise capital, that's a lot of stress on your back, because if you don't deliver the results to your LPs, your limited partners, and maybe you lose money, or, people actually lose money. You don't always win.
That's another good point. I mean, that's the thing with what we're seeing is with the syndicators, and God bless them. I mean, again, I'm one of them, right? In a way, is just though that you couldn't really f up a multifamily deal in the last 10 years, right? And so I don't know. There's a little bit of like I think, Bo, and correct me if I'm wrong, there have been some people who've gotten into this game and they're putting together deals that are, they're on a shoestring and they're barely making sense. And if there's just a bit of a correction, it could just become toppling down in this, especially in this industry of, you listen to all these people doing it. The podcast became huge. There's so many people that are saying they're, syndicating, and they're doing, again, I know there's 90% of them are doing it the right way, but there's the scary 10% where it's like, hey, by the way, you can lose money, and you could be losing. Also, you can lose money on people who do a good job, right? So that's a part of investing. It's not always a win.
Yeah. And I interviewed a gentleman yesterday, and he owns a lot of multifamily student housing. When COVID happened, his occupancy went from 90% to like 49%, right? He told me on one project right now, he's stroking a check for $110,000 a month.
Oh,
And he said, that's why I'm super, and now it's come back and he's starting to do better. But he said, that's why I always take money and I have a nest egg, because who would have guessed we were going to have COVID and student housing went from 90 to 45% occupancy or whatever, right?
that
So,
black swan event, that black swan
so,
event.
so, so fortunately, this guy was smart and he put away millions of dollars. So, I mean, 110 a month probably hurts, but for him, he prepared. So even when you're flipping properties, you got to be careful. And, everybody's like not really thinking like, so I get a lot of newbie people that want fix and flip money. And it's like, okay, well, they send me over their information. I'm like, okay, there's not that much money in your bank account. Who's putting the money down? Oh, okay, we're getting money from this person. Okay, great. And like, what nobody thinks about is like, even though I'm lending 85 or 90% of the purchase price and 100% of repair costs, what about your carrying costs? You got to pay that $2,000 mortgage payment every month. Utilities. What happens when your $50,000 construction budget becomes $80,000? And when you're doing a construction holdback, you only get paid, you only get those draws when you make progress. So when we fund these construction rehab loans, I have 50,000 allocated. We look at a line item construction budget, and you got to make progress before you get your first draw. So I'm like always trying to tell people, listen, you need down payment, closing cost reserves, miscellaneous, contingency reserve, and you need money to get the project started. Because what happens if you like close on the deal and now you're like trying to scrape your pennies together to get the contractor to actually do work? And so
Happens.
people fail before they even start because
Oh, it's good, man.
they're not planning. They got to plan. Like you got to think about this because that's how you get burnt. And everybody
Well,
thinks, yeah, it's crazy.
no, but that's why you teamed up in the beginning. That's why you know, a third, a third, a third. And yeah, maybe you didn't get 100% of the proceeds, but you learned a ton. You still got paid. You got the information you needed, and then you got a track record. You got credibility. So you see these people that just try to like, they try to think that it's, you know, it's everybody against themselves, and that's not the right way of thinking about it. You got to try to get as many people involved, especially in the beginning, so you can build up that win. You need wins in the early on to get that traction and really, you know, push that ball up the hill. So that's awesome. It's so true. So true.
Yeah. And then so many people right now, I want to quit my W-2 job. I want to go full-time real estate. Well, that's great. I love the ambition. But sometimes I tell people, relax, buddy. Keep your job. It's easier to get bank financing. Let's stack up 12 months of reserves before you go full-time. Let's think about these things. Like think about even right now, all these people that are planning to burr their properties and use these DSCR loans, they were underwriting the deal with 4% money and now they're paying 6%, right? So what's that going to do to the whole equation? And
Great point.
also, and also all these people buying short-term rentals, which is a great business. I have people crushing it, but is it more of a demand now because of COVID? And like, is this going to normalize or will this trend continue? These are things that are kind of unknown. I mean, people always talk about there's shortage of inventory, which is true. But like once the media starts talking and there becomes that negativity in consumer mindsets shift, right? Like all of a sudden, we got to remember the government just printed trillions of dollars. So people have all this SBA, you know, PPP and idle loans and all this stuff. So that kind of helped a lot of people, right? Because they gave 30-year loans at 3.75% to people, business owners. And so a lot of people, you know, I talk to people all the time. These people that were doing pretty good get like $2 million idle loans. So that's helping the economy. They were pretty smart. Like I think the money went to people, business owners that necessarily didn't need the money, which is probably the plan, because if they didn't really need the money, then those are the people that would probably best utilize the money to grow their businesses. So I think it didn't really go to the people that like are homeless, and it went to business owners, which was smart by the government actually, because that did stimulate the economy pretty well. Because when you get a chunk of change at 3.75%, you can grow your business pretty significantly, right? Like
You
you
can
got a
do a lot of
couple,
those capital improvements, the hiring, all the things that, you know, the government probably we needed at the
yeah,
time, right?
yeah.
Is get that money going and working. No, that's awesome. You know, Bo, one of the things that we always think about, you know, here is, you know, what's the next step, right? Like what's it look like in 5 years from now? So like for you, two things. What do you think the economy, or I guess I should say, what does the real estate market look like in 5 years? Or maybe even a year. Like I don't
Yeah.
know if you can even think that far out because I know it gets a little tricky, but are we good? Like are we good, buddy? Like we got anything to worry about? Like I know you see these interest rates are increasing, and are people screwed? Are people refinancing because they need the money? What's the deal? What are your thoughts there?
So I missed the boat. I should have been I had a loan in to refinance 3 of my properties. And for whatever reason, they didn't order the appraisal on my 4-unit property. And like, I got it like 45 days after I put my loan application, and it pissed me off, right? Because the rates went up 2%, but there's
Damn.
nothing I can do. But the point is I'm pulling out the cash and securing 30-year debt, even though the rates went up, because I can utilize that cash now. Because real estate usually in inflationary markets are a good investment. So I think all in all, historically real estate is the best investment. It's just that you have to be able to withstand certain pressures and downturns that might come about in the future. So as long as you are buying for the right purposes and not stretching yourself too thin, then I think you're going to be fine. So that's what the goal is for everybody. It's like, have a little bit of reserves, not too much, because we're in inflation and money in the banks, you're losing money, right? So, and I think that you should diversify a little bit. I think everything should be focused on cash flow, not appreciation.
So
So,
all in on crypto. Is that what you're saying?
I don't really know much about the crypto market. I mean, if you understand it, I think people have made money in it. But if you don't understand it, you should probably wait. You should get
Yeah,
educated before you invest. But I
100%.
but I think at the end of the day, what's your financial independence number? If it costs Marty,
Right, right.
$8,000 every day or every month to pay his bills, and to put food on the table, pay insurance, once you get $8,000 in reoccurring revenue that you're not actively working for, then we call that being 100%er, meaning you have enough
Ooh,
cash
I
flow
like
to,
that. That's the
yeah.
number, 8K.
So then you work towards being 150%er. Once you get to about a 200%er, where like it costs Marty $8,000 a month, but now he's got $16,000 a month coming in, then he's a 200%er because he has that extra $8,000. Right. So once you have that extra $8,000, all you do is then you're like a full-time investor.
Ooh,
You
I
just,
love that. That's a great, I've never heard that. That's awesome. What's that called? Just be a 2%, be a 200%er.
yeah. So you start first, your goal is write out all your expenses, what it costs, food, movies, sushi, everything.
Okay.
What's that number? And it's going to scare you. I did that one time and I was like, oh my God, no wonder why I have no money. I have like, I mean, I have apps right now. I'm paying $400 a month for. I'm like, do I really need this? Is it really moving the needle for my business? So you add up all these expenses, and then that's the first step, because that's like a rude awakening between
Right.
like Google storage and Zoom and this and that and that. And you're like, whoa, I know most of it's business, but it's like, where can I cut there that I'm not using that? And maybe you save $1,000 a month. I'm not big on saving the money. I'm more big on making the money.
Yeah.
And then what I need to do is like, you set up another bank account that you don't see and you don't use, and you just have like $200 or $300 every month just going to that bank account, right? Like, because for me,
Great tip, Bo. Great
because
tip.
yeah, then
Let's go.
because we know like you can go out and buy $100,000 properties in the Midwest, and you need 25 grand, right? So every year you should be able to put that 25 grand away, and then like you buy a rental,
Oh, I love that move, bud.
one rental at a time is all it takes, really, right? It's not like you have to, if you do it that way, you don't necessarily need to be a tycoon. You could just buy one house at a time. You could be strategic. You could house hack your first deal. I get an FHA loan. I move into this duplex. I rent the other. I live for free. I save $1,500 in rent. I take that $1,500 and save it. That's how you propel your wealth. And so, that's the key. It's like, make money and then do strategic moves, because you don't even need to be a real estate investor. You could just
That's
go.
a good point.
When I bought my first house in San Ramon, California, couldn't qualify for a loan, so I did a lease option and I set the price. This was my first house at 21 years old, or 22 maybe. So I leased it for 12 months with the option to buy it at 325,000. When I went to exercise the option to buy it, the house was worth 375. That was my first real
Damn.
estate deal. I just made $50,000 equity. Even before house hacking, I had my rooms rented out to my buddies. And I was like, I was doing this before Bigger Pockets, like, although like I should have been smarter, because that $300,000 house is now $1.2 million. So I should have kept it. Should have kept my house in Tahoe. Should have done that. Should have done this. I didn't follow a lot of things I should have done, which is just hold real estate, because that's where you get really wealthy. It's just holding the real estate. If you're
Yeah, and being
flipping
in the right
properties,
spot too.
yeah. What's the point of like flipping a bunch of properties and paying like 35%? Let's just say Marty made $1 million, and then he goes to he flipping houses last year. And then he goes to his tax account and he's got to pay 300 grand in taxes. Like, you got to have those other strategies like cost segregation, and you got to learn all these little tools. Because I showed my friend the cost segregation. Hey, you should look at doing that. And it saved him like 200 grand this year on his taxes that he would have to
Wow.
pay. there's like, you have to listen, and like, these are the things that people get really successful and make money from. It's like pay less taxes and buy more appreciating assets.
Yeah, they want you to, right? I mean, that's what the IRS has. Like, they have these codes because they know real estate is important. They know that these investors who are, going through the turmoil of providing housing and really getting into this market, you deserve these credits. You deserve some of these breaks because they can't do it. They know they're not good at it. So they need investors, they need people to kind of think outside the box and do these kinds of things, and you should get rewarded for it, right? I mean, that's the truth.
Yeah, we take the risk. We
Take
can
the
easily,
risk.
we can lose money. We stress, like I, I've been pretty much self-employed my whole life, and I can tell you it's not the easiest journey. I've been transaction based, originating loans, and like, that's no way. I would have done things way different. But all I could do now is just say, hey, people, like, if you're looking to get into real estate, here's what I would do now after 20 years of watching people be really successful. It's just these baby steps, right? Like, just the baby steps. Like, you can just be strategic, get an FHA loan, buy a duplex, live there a year, go buy another one. You can do that every 3 or 4 years, and you can end up with a portfolio of 12 units with good long-term debt on it, that like, and you don't have to really think about it. You're just moving every couple of years and buying strategic properties. You're not really out there actively looking at deals. And, not everybody needs to be a deal junkie like Marty, right? Like, because it like, you have to be on it 110% of the time to be successful, right? Like, if, like, you're probably so wired that like, you have to do it this way, and not everybody can handle that intensity,
Well,
nor
you're
does,
so right. You're so
nor
right.
do,
It's almost a hindrance. Honestly, I think that, if we maybe went slower in the beginning, obviously I wouldn't change anything because I'm ecstatic on where things are going. But, you've got such a good point there. Go slow, do the house hacking, the FHA. Here's what you got to do, though, and here's what people don't want to do. It's going to be uncomfortable to have a duplex and be a house hacking in your first buy. Yeah, you're not going to get your dream house. That's going to come 5 houses from now, right? After you sell the two, right? Or you don't do it at all. You just do it smart, and then you just keep refinancing, and then that's your down payment for your that magic house that you're looking for. But people don't want to do that, Beau. They don't want to do that. They don't want to go slow. They want that brand new house today. But yeah, you're right. If you can, the other thing is you got to find a partner that's willing to house hack with you, or you do it when you're younger and you're single. Beau was smart. He waited to get married, right? You just got married like what, a year ago, 2 years ago?
yeah, a little over 2 years ago. So yeah,
That's
yeah.
the
I
way to
mean
do
it.
it.
Yeah, but I made a lot of mistakes too.
Yeah.
So I think I have educated myself, but yeah, I mean, I think you start small. People get overwhelmed. Another problem you see is people, um, they get a taste of success on a first deal, and all of a sudden, like, they buy like 5 properties at once, and then they realize it gets a little bit more difficult, because now you have 5 properties, you've done one deal. Like, when I first went and started buying in the Midwest, we bought all these big renovation deals, and we didn't have the team. It was like the stupidest thing ever. We should have bought cosmetic deals, got them rented out, and then kept on replicating. I got hung up because I bought these early 1900 houses that needed these huge renovations, and trying to find contractors, if anybody's deals with contractors, is not the easiest thing, and especially in this market. So, these are learning mistakes that I see reoccurring. Everybody's like, all these flippers, oh, I got this deal under contract in San Francisco, because that's where I grew up. So I did a lot of deals in the Bay Area. And these guys would come in and like, oh, I'm buying it for $1 million. I'm going to put in 500. I'm going to sell it for 2.5 million. Well, the problem is, you got to get plans, permits. You got to be able to carry that $10,000 a month debt payment. And people don't think about it. And then the reality comes. And I've seen so many people, even in a huge appreciating market, get their butt handed to them.
Yeah, that's a good point.
Yeah. Yeah. I did, the biggest deal I've done was like I forgot what we bought it for. It was like $1.5 million purchase. And we were putting like, originally we're going to put like 200 in, and ended up being like 400.
Oh God.
But I remember it's like $12,000 a month of debt payment. And it took we had a contractor that basically walked off the project, and we had to pick up pieces. and thank God that the market in San Francisco at the time was booming, and we ended up breaking even. I think I might have lost like 4 or 5 grand of my own money, but that could have been so ugly. It could
Could
have
have
been
been
so.
so much worse. Thank
Yeah,
God the market was in our favors.
yeah. I know. I interviewed one guy, and I think he lost 200 grand on a flip in the Bay Area.
Minga.
And then he's like, I'm getting into buy, fix, and hold. I'm like, yeah, that's probably a better. And now he's crushing it. He's got 30 something rentals, and so if somebody's never lost in real estate, they probably haven't done enough deals, because you're gonna lose on a deal. And it's just the bottom line. Like, you can't bat 1,000. You just can't. And some
No,
deals,
and I don't want to work with people who've bat 1,000. And that's why, guys, for people who are thinking about, looking for lenders on anything, Beau can handle all of those things for you. I mean, at least reach out to him. He's probably one of the most active on LinkedIn. He's got his website. Beau, what's the website people can go to if they want more information on you?
sure, they can go to beaueckstein.com. That's BEAUECKSTEIN.com. Or they can go to my podcast too. They can listen to, I talk about lending, which is investorfinancingpodcast.com, or you can go to YouTube and find it, and go in the search bar and put Investor Financing Podcast, and you'll find the show. We talk about financing, and we interview real estate investors too.
It's an amazing show. Beau's an amazing guy. And I know that for people who are looking to talk to people in real estate, you want to talk to somebody who has been through a few cycles and also got out of them and being even more successful after. And Beau is that kind of guy. Beau, I just want to be cognizant of your time. I thank you for showing up and being a part of this. This is a journey, and God bless you in your journey.
Thank you very much. It was great to be on the show, and look forward to connecting with you again, Marty.
Hell yeah, brother. Thanks for being here. See
All
you
right.
guys.